Welcome to our deep dive into the world of hedge funds, where success isn't just about making money but about measuring performance with precision. In this video, we'll explore the essential metrics that hedge funds use to evaluate their strategies and outcomes. Whether you're an investor, a finance professional, or just curious about how these funds operate, understanding these key performance indicators is crucial. Let's start by setting the stage. What exactly makes a hedge fund successful, and why do these metrics matter so much in the competitive world of finance? Let's find out together. Success in hedge funds isn't just about absolute returns. It's about how those returns are achieved, the risks taken, and the consistency over time. Hedge funds are judged not only by how much money they make, but also by how well they manage risk and outperform benchmarks. This means that a successful hedge fund is one that delivers strong risk-adjusted returns, maintains transparency, and aligns with investors' goals. In the next scenes, we'll break down the specific metrics that help measure these aspects of success. Start with absolute return, one of the most straightforward metrics. Absolute return measures the total gain or loss a hedge fund achieves over a specific period without comparing it to any benchmark. This metric gives investors a clear picture of how much money the fund has made or lost regardless of market conditions. However, while absolute return is important, it doesn't tell the whole story, especially when it comes to risk. That's why other metrics are also crucial for a complete evaluation. Relative return takes things a step further by comparing a hedge fund's performance to a benchmark, such as the S&P 500. This metric helps investors understand whether the fund is outperforming or underperforming the broader market or its peers. Relative return is especially useful for evaluating active management skills and strategy effectiveness. If a hedge fund consistently beats its benchmark, it's a strong indicator of skillful management. But remember, context matters. Market conditions can influence these results. Risk-adjusted return is a cornerstone metric for hedge funds. It measures how much return a fund generates for each unit of risk taken. This is crucial because high returns can sometimes come with high risks. By adjusting for risk, investors can see whether the fund's performance is truly impressive or just the result of taking big gambles. Common risk-adjusted metrics include the Sharpe Ratio and Sortino Ratio, which we'll discuss in detail soon. Sharpe Ratio is one of the most widely used risk-adjusted metrics. It calculates the average return earned in excess of the risk-free rate per unit of volatility or total risk. A higher Sharpe Ratio indicates better risk-adjusted performance, meaning the fund is generating more return for each unit of risk. This helps investors compare different funds or strategies on a level playing field, regardless of their risk profile. While the Sharpe Ratio considers all volatility as risk, the Sortino Ratio focuses only on downside risk, returns that fall below a target or minimum acceptable level. This makes the Sortino Ratio particularly useful for investors who are more concerned about losses than overall volatility. A higher Sortino Ratio means the fund is delivering strong returns with fewer downside surprises, which is often more aligned with investor goals. Alpha is a measure of a hedge fund manager's skill in generating returns above the market or a benchmark, after adjusting for risk. Positive alpha means the manager is adding value through active management, while negative alpha suggests underperformance. Investors look for funds with consistent positive alpha, as it indicates true skill rather than just riding market trends. However, achieving alpha is challenging and rare, making it a prized metric. Beta measures a hedge fund's sensitivity to market movements. A beta of 1 means the fund moves in line with the market, while a beta less than 1 means less volatility, and more than 1 means more volatility. Investors use beta to understand how much of the fund's performance is due to market exposure versus manager skill. Low beta funds are often sought for diversification, especially in volatile markets. Maximum drawdown is a key risk metric that shows the largest peak-to-trough decline in a fund's value over a specific period. It helps investors understand the worst-case scenario for losses and how long it might take to recover. A fund with a smaller maximum drawdown is generally considered less risky, which can be especially important for risk-averse investors. This metric provides a reality check on potential downside. Volatility measures how much a hedge fund's returns fluctuate over time. High volatility means returns can swing widely, while low volatility indicates more stable performance. Investors often prefer funds with lower volatility, as these are less likely to experience dramatic losses. However, some strategies intentionally embrace volatility to seek higher returns. Understanding a fund's volatility helps investors match their risk tolerance with the right investment. Standard deviation is a statistical measure of the dispersion of returns. In hedge funds, it's used to quantify volatility. A higher standard deviation means returns are more spread out, indicating higher risk. This metric is often used alongside others like the Sharpe Ratio to give a fuller picture of a fund's risk profile. By understanding standard deviation, investors can better anticipate the range of possible outcomes. Tracking error measures how closely a hedge fund's returns follow its benchmark. A low tracking error means the fund closely mirrors the benchmark, while a high tracking error indicates more deviation. This metric is especially important for funds that aim to outperform or replicate a specific index. Investors use tracking error to gauge the consistency and predictability of a fund's strategy. Information ratio is another key metric, showing how much excess return a hedge fund generates per unit of tracking error. A higher information ratio means the fund is delivering more consistent outperformance relative to its benchmark. This is particularly useful for evaluating active managers who aim to beat the market. Investors look for funds with a high information ratio as a sign of skillful and consistent management. Liquidity refers to how quickly and easily a hedge fund's assets can be converted to cash without significantly affecting their price. High liquidity means investors can enter or exit positions with ease, while low liquidity can pose challenges, especially during market stress. Hedge funds with illiquid assets may offer higher returns, but they also carry higher risks. investors must balance the trade-off between potential returns and the ability to access their money. Capacity measures how much capital a hedge fund can effectively manage before its performance starts to suffer. As funds grow larger, it can become harder to find attractive investment opportunities, leading to diminishing returns. Understanding a fund's capacity helps investors gauge whether it can continue to deliver strong results as it scales. Managers must balance growth with maintaining performance. Hedge funds typically charge both management and performance fees. The fee structure can significantly impact net returns for investors. Commonly, funds use a 2 and 20 model, 2% management fee and 20% of profits. It's important for investors to understand how fees are calculated and how they affect overall performance. Transparent and fair fee structures are a sign of investor-friendly management. Transparency is a qualitative metric, but it's just as important as quantitative ones. Investors want to know what's happening inside the fund, what assets are held, what strategies are used, and how risks are managed. High transparency builds trust and allows investors to make informed decisions. Funds that are open about their operations are often more attractive to sophisticated investors. Consistency in performance is a hallmark of a successful hedge fund. Investors look for funds that can deliver steady returns over time, rather than those with erratic results. Consistency suggests a robust investment process and disciplined risk management. It also helps investors plan and allocate their portfolios with greater confidence. Choosing the right benchmark is critical for measuring hedge fund performance. The benchmark should reflect the fund's investment universe and strategy. An inappropriate benchmark can distort performance evaluation and mislead investors. Fund managers and investors must agree on a relevant, transparent benchmark to ensure fair and accurate comparisons. Summary: measuring hedge fund success requires a holistic approach. No single metric tells the whole story. By combining quantitative measures like returns, risk, and ratios with qualitative factors such as transparency and consistency, investors can make more informed decisions. The right mix of metrics help identify truly exceptional funds and avoid potential pitfalls. Thanks for joining us on this journey through hedge fund performance metrics. Here to Smarter Investing.